In this week's update, where can you most confidently invest? Time to start building again into precious metals? And what about the other commodity booms? And looking at opportunities from both sides. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, let's start with some market perspective because things are still moving pretty quickly, and we've had a few ups and downs in the last few months, but overall it's been very positive. But if we look at the bond market, which is far bigger than the equities market, and it's a market that can't be ignored at any stage because there's a lot of very valuable guidance comes from the bond market. So what is it actually telling us? We've got rising yields now, and that means if yields are going up, then that means that bonds are being sold. And if bonds are being sold, then that money has got to flow somewhere. And not all of it, but most of it is going to be flowing into equities. And I think connecting the dots at the moment, it seems to me that probably most of that money is going into the recovery stocks, the stocks that were badly dealt with coming out of the COVID crash earlier in the year. That seems to be where most of the money's going. And the reason that I say that is because pretty much all sectors now are rising. The aggressive sectors, the defensive sectors, the sectors that have done well out of COVID, the ones that haven't done well out of COVID, it's pretty much everything is on the rise. So the obvious conclusion to me is that the sector rotation that we've seen over the last month or 6 weeks is settling down, because technology stocks are also doing well again. So that rotation, that internal rotation from the technology stocks, consumer discretionary stocks, where money was coming out of those areas and going into the more defensive areas, I think that's probably settled down or stopped. And the continued rise is in the more defensive sectors is coming out of the bond market. So that all spells the pretty high probability that we're going to get a pretty reasonable run into Christmas. And we often get a Christmas rally, and everything seems to be set up this year for that to happen again. Just one word of observation, though, is that we've got, and I've spoken about this before, we've got an enormous number of call options in the US that are deep in the money. And when you get that situation, we can quite often get some volatility around options expiry, which is the third Friday of every month. That normally happens. We may see it happen to a larger extent this time, but it's only something that generally lasts for a few days to a week. But just be aware that in that third week, and possibly into the week leading into Christmas, we could see some volatility. But overall, things look pretty good for the finish of the year. So we've got this fight on at the moment between the bond market and the Fed. So we've had a 35 to 40 year bull market in bonds. So that means bond prices going up, yields going down. And we certainly appear to be at a potential reversal point of that very long-term trend. So we've now got market forces are pushing yields up in expectation that we're going to get a global reflation with vaccines now, COVID under control, massive amounts of stimulus in the system. That's what the market is betting on. But of course, the Fed and other central banks can't allow that to happen. They've spent the last 5 to 10 years trying to depress yields to stimulate economic activity. So they can't afford to allow yields to rise. So we've got this massive fight on where the Fed is buying up bonds as fast as they can to try and stop yields rising. Who will win out of that? Time will tell. But there's an old saying about never bet against the Fed, and it's probably pretty unwise to do that. But nevertheless, there are some very powerful market forces that are pushing yields up. So how does this play out? Look, the Fed is effectively devaluing or debasing the value of the US currency. And that's why the US dollar has been in downtrend for some time. Now that, of course, means that that puts upward pressure on commodity prices just based on the currency effect alone. And then, of course, rising commodity prices feeds into inflation, which takes us right back to the top of the slide, where we've got, market forces expecting the global economy to reflate. So we ended up with this self-propelling spiral to the upside. So the Fed's going to have a very hard task on their hands. All of this, to me, spells a lot of stresses in the financial system. So I think we are periodically going to see, from here on, more bursts of volatility. As you know, I believe we're in a secular bull market that started in 2013 and could extend to 2030 or beyond. But of course, along the way, there will be more episodes like what we saw in March of this year. I'm sure that there will be many instances where the market goes down by 20% or more at the index level. So it's certainly not going to be a straight line run, that's for sure. But there's going to be wonderful opportunities. So it's just a matter of learning how to deal with that volatility. So what about the rally in value stocks? I've been talking about that over the last couple of months. So we'll look at those relationships just to see what those charts tell us. But from my perspective, the most important thing is to find reliable earnings growth, almost near certain earnings growth. And I want to talk some more about that. Now, many tech stocks have got that, particularly in certain areas around 5G and in medical science. But most value stocks don't have it. That's not to say that their earnings aren't going to grow. What I'm talking about is highly certain growth. Most value stocks don't have that because there's still so many uncertainties out there. So the value stocks are up against economic uncertainty. I don't think anyone can put their hand on their heart and say that things are just going to zip back to normal in economies around the world and everything will be fine. That's just not going to happen. And of course, we've still got virus uncertainty as well, with the virus absolutely rampant in America and in some parts of Europe. So there is a lot of uncertainty there for all stocks, but some stocks are pretty much unaffected by it. And then on top of that, value stocks are also the ones that are most exposed to the forces of disruption in all sorts of areas. So there are numerous things that are against the so-called rebound or value stocks, however you want to term it. And it comes back to the point I'm making before. Where is the most reliable earnings growth? Where is the near certainty of earnings growth? And for me, investing profits are all about probability. We want to find the groups that have got the highest probability. You can't just look at gains, or you can't just look at the profit position from one side. In other words, how much money can I make? You've also got to look at how much money could I lose if it goes wrong, and what is the probability of those gains or losses occurring. So you've got to look at the whole equation. And judging by a lot of the comments and questions that I'm getting, I think a lot of people are getting dazzled by the opportunities that, crude oil might rebound. And so the energy sector that's been out of favour for so long could have a great run. So we'll jump on that. You've got to look at the whole equation. You've got to look at the downside risk and you've got to look at the probability of things happening. And for me, there are certain areas of the market where that earnings growth is almost certain. And we're talking about areas like 5G. The 5G revolution is going to happen. The infrastructure build out around the world is going to happen, come what may. Doesn't matter what the virus is doing. It doesn't matter what central banks are doing or bonds are doing. That is going to happen. The explosion of artificial intelligence and all of its applications is going to happen. It's absolutely certain that it's going to happen. Cybersecurity, you could put in the same basket. Let's look at the medical field. The gene editing side of things is just such an exciting new branch of medical science. And biotechnology and the use of software in biotechnology is just incredible. And then you can go into other areas, advanced manufacturing, 3D printing, 3D additive manufacturing. if you're not excited about the next 5 to 10 years, then, frankly, I don't think you've got blood flowing through your veins. It is the most exciting period that I think any of us have ever seen. So an incredible opportunity ahead of us. The way that I'm approaching it is to get focused very narrowly on the stocks that are almost certain to benefit from that. And I'm just staying away from stocks where there is any sort of level of uncertainty, even though they might offer me 30, 40, 50, even 100% rebound gain. Unless I feel that that rebound is highly certain and highly probable, then I'm just staying away from it. So that's my way of approaching the market. All right, let's turn to American stocks. The S&P was up 1.7% for the week. The economic data is coming through a bit mixed now, so there certainly are a few potholes in the data, and that has caused some volatility, but it tends to only last for a day or two at the most, because it's just all getting overwhelmed by the euphoria around the new vaccine announcements that are coming out. And then, of course, we've got the likelihood of just massive stimulus coming through, particularly in America. So those things are just overwhelming the negative or any negative economic data that's out there. The US dollar, it continues to fall, got down to almost 90 during the week, and the 10-year yield is still rising. We're now up at 0.97%. So very interesting things happening there. Okay, let's have a look at the charts. So this is the S&P, new all-time highs. We finished basically at 36.99, so call it 3,700 points. So all-time high, never been there before. And the way things are setting up at the moment is that we've got all indices doing well. The S&P, the NASDAQ, the Russell, the Dow. And what's most impressive from my perspective is especially the small caps, the Russell 2000. This is a very robust, broadly based rally. And when you see that sort of thing happening, you know there's a very good chance that it's going to be sustainable. So we've got all sectors rising. We've got the aggressives rising, technology, consumer discretionary, communication services, software. But we've also got the the stocks that had been, or the sectors that have been lagging, and they're performing as well. So all of this, where everybody's joining in, certainly makes the rally more sustainable. Let's look at the QQQ, which is the ETF that tracks the NASDAQ, and you can see we had a bit more volatility in the NASDAQ as we got that sector rotation happening, but we closed at a new all-time high on Friday night. So the NASDAQ is doing very well. If we look at some of the spreads, so this is the Russell 1000 growth stocks versus value stocks, one divided by the other. We've been looking at this every week now for the last month. And you can see we are just now effectively going sideways, which is what I thought was unfolding. And that's continued to play out. Neither side is being favoured. There's money flowing into both sectors, so they're sort of roughly in balance, and that's why the ratio is going sideways. If we look at consumer discretionary against consumer staples, the money is still going, very freely into consumer discretionary. This is not a market that is going to hide in consumer staple stocks. And if we look at the industrials, so this is industrials versus the S&P. That line has been rising since May and is still net rising. So things are all looking pretty good there at that level. Okay, US dollar continues to track down. So we went sideways from basically the start of August until late November, and then we've keeled over and we're on the way down again. The next level of support is coming up at about 89.5. So not that far away, and if that were to break, then we've got quite a way down. We go down into the mid 80s. And of course, all that is putting upward pressure on the Australian dollar. So we're now back to just over 74. And at the moment, the way the trends are going, you'd have to say that the Australian dollar could work its way towards 80 cents during 2021. Now, that's not going to be at all good for our economy. So it'll be very interesting to see what the RBA has to say about that. All right, turning to Aussie stocks, there was our dollar high at 74.03 and our index gained 0.5%. But look, there's certainly a lot of overseas money, and overseas money typically, under normal circumstances, makes up about 40% of our market. There's a lot of overseas money that's effectively playing a currency trade here with the local large caps. That always makes me nervous because it's unpredictable. When and what if they decide to change and do something else with their money? So again, the local large caps in Australia are subject to unpredictable forces that we can't know and understand, and we don't get any forewarning of when they're going to change direction. So that's one of the reasons that I'm still quite wary on Australian large caps, because there is just this. It's not a natural market in my way of thinking. I see much more predictability. So again, coming back to the probability of earnings growth, I see a lot more predictability in the small cap area in Australia, and we've got some fabulous performers in that area. Turning now to precious metals, gold was up $49 to 1839. There was a big negative move the prior week. I didn't do a video last weekend, but that would have shown quite a significant negative move, and that was really the washout, the capitulation that I was looking for. So the odds now favour the fact that the correction is finished. The last time I addressed this 2 weeks ago, there was some signs, but I was still unconvinced. I think with this washout that we had and then the reversal last week, I think we can feel pretty comfortable that we may have seen the lows in the sector. However, these reversals often don't occur in a nice V shape. Sometimes it takes a couple of weeks of the price going up and down, possibly even forming another slightly lower low before the recovery really takes hold. So for me, nearly all the boxes have been ticked for a sector reversal. So I think it's reasonable to start to rebuild exposure steadily into the precious metals sector, but I certainly wouldn't be going all in at this stage. So let's look at the precious metals sector. Okay, so this is gold on a weekly chart. You can see we had this strong channel that had been in progress. Basically, it started in 2018, and we got out of it leading into the end of August. So the market got right ahead of itself, got way ahead of trend, and that's why we had to have this correction. We had to have this washout. Didn't look like it was going to come back for a long time there, but eventually the market forces took over, and we got that washout, and then quite a nice reversal last week. So the bullish case is back on, and here's why. So these are all the boxes that I was looking to be ticked. The 200-day moving average on gold was tagged. So there's the daily chart, the red line, 200-day moving average. So that one got ticked. The correction hadn't really run long enough and deep enough for a typical corrective phase. Well, that now, both in terms of time and distance, has been fulfilled, I think, for a correction. And then, of course, gold stocks tend to lead the underlying metal in both directions. And GDX had slipped below its 200-day moving average. So that was another box that was ticked. So let's just look at GDX. So there's GDX, which slipped under its 200-day, but then very quickly turned around. And the final thing, or the final couple of things, is that GDX then started outperforming. So gold was down for a couple of days. So gold went down the previous week on the Monday. It went down heavily on the Monday, the Tuesday, and the Friday. Yet if you look at GDX, GDX only went down on the Monday, but it then started turning around and trading higher later in the week when the gold price was still falling. So that's always a pretty good indicator. And then finally, just in the commentary that I read, sentiment had remained pretty positive. A lot of people were still very bullish on gold and gold stocks. Well, that finally, in the week that gold fell heavily, that started to shift. And I started to see in the commentary that there was a distinct tone of fear about how much further the gold price might fall. And of course, the inevitable bearish commentators came out and started predicting that gold would fall back to $1,100 and all this sort of stuff. So to me, that was the final thing when the commentary starts turning bearish. So to wrap it up, I can't be sure that the correction is finished, but all you've got in the market is the probability of upside versus downside. That's all we have. And you want to invest and trade when the odds are very significantly in your favour. So for me, the potential upside far outweighs any further short-term downside. So, this is a point where I think you can start to rebuild into the precious metals area. All right, just looking at silver quickly. So silver has actually done a bit better than gold. You can see that silver didn't ever make it down to its 200-day moving average. So there's certainly been relative strength in the silver market. So that's the precious metals complex. Now we've got some other good things happening in commodities as well. Copper up very strongly to $3.51. And so what we've got here, we've got the forces of a weaker US dollar is pushing copper up. We've got a global reflation expectation happening, so that's pushing copper up, expecting that demand will continue to increase. We've got China, stimulating its economy massively through an infrastructure build out, and that places greater demand on copper. And then overlaid on top of all that, of course, is the expectations around the move into electric vehicles, which is really gathering pace very, very quickly. So there's a lot of things pushing copper. And if you look at what happened to the copper market coming out of the GFC, when China just put a staggering amount of money into building out infrastructure, I think that's happening again coming out of this COVID crash. And there are certainly indications that it could even be bigger this time than it was back in 2010. The forward projections at the moment are the copper market will be in deficit to the tune of about 400,000 tonnes by 2024. We're also looking at deficits in the other base metals as well, nickel, zinc, etc. So it's a pretty bullish picture, not only for copper, but for other base metals as well. So I think you'd be certainly entitled to be thinking about what sort of stocks could fit into your portfolio to play that theme. Now, crude oil also did well, shot up to 46.26, but this gets to the heart of what I spoke at the start about, and about probability and about certainty of future earnings. The facts are that the XLE, which is the index for the overall energy sector in America, has been underperforming the S&P for the last 9 years, and we'll look at that chart in just a minute. So that's the reality of the situation. Now, there is probably a good bounce trade going on in energy, but what are the risks around that? Yes, you can make a profit, but what are the risks? And what are the odds of it continuing? So, to me, it just doesn't have the same level of earnings, future earnings certainty and future earnings growth that all the other sectors that I talked about before in digital technology, in medical technology, and in advanced industrial technologies as well. So that's my view. That's how I approach the market, and I tend to stay away from the areas that I just don't feel offer the same level of probability. Before I go on to copper, let's just have a look at the oil sector. So if we look at XLE, so this is the overall energy ETF in America. So we peaked in 2014 in the energy sector, and it's been on a big picture view, it's been heading down ever since. Now we seem to have formed a base, and yes, this could rebound up here. So we've already rebounded from around 30 to 40. We could go to 50 or 60. That is entirely possible. But what is the probability and what is the downside risk? That's the question. And this is the spread. So this is the spread between the S&P and the energy sector, XLE. So when the line is rising, that means that the S&P is doing better. And you can see that the line has been rising since 2013, 2014. Slowly at first, and then meteorically as the energy sector underperformed dramatically since about August of 2019. Now, we've just had a significant adjustment. So this fall here tells you that the energy sector is doing better than the S&P. But is it already done? Is it over? We saw a sharp correction in coming out of the COVID crash, where the S&P really fell very hard. So, are all the gains pretty much in place? I don't know. But I don't like to invest in areas of uncertainty. To me, investing is not a hope game. It's not a guessing game. You've got to feel very certain that it's going to play out the way that you want it to play out. All right, so there's copper. So you can see it's been on a real tear since March. We got down almost to $2. We're now above $3.50. If you look at I had some other charts, but they don't appear to have come up. So I was also going to show the charts of the 10-year copper chart, which shows that there is still plenty of upside in copper. If we look at where the copper price was back in 2010, there is still plenty of upside on copper. And also nickel and zinc and lead charts are also looking extremely positive. So to wrap it all up, we've got a coming commodity boom. There's no question about that. It's in copper and it's in the wider base metals complex. So you should be, starting to get your thoughts in order about participating in that, because I think that commodity boom is going to last for, probably another 5, 6, 7 years. That's typically what happens. And then we've got all the other booms as well in digital technology. So I talked about this earlier: digital technology, medical science, advanced manufacturing, and of course, don't forget, on the commodity side, uranium is waiting in the wings. It's inevitable that the uranium sector is going to pick up. Now, it's taking far longer than nearly everybody expected, but we must be getting closer and closer to the point where uranium is going to have its day in the sun as well. So there is opportunities, high probability opportunities in many areas. Portfolio analyst this week is really just recapping on quite a large number of very profitable trades that we've had in recent months and weeks. So that's it for this week. There's my website for further information and my email address if anyone would like it. That's it for this week. I'll be back with you next Sunday. Cheers.